Hello, everyone. Welcome to Money Minutes. I'm your host, Zak Gardezy. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, here on Money Minutes, I like to share with you some of the latest market headlines and my outlook for what's ahead. So, for this week's episode, I'll talk about the stock market, which is at an all time high. I'll talk about why we're here and what are some potential risks. Could the stock market come crashing down? And if so, what could potentially cause that to happen? And then lastly, I'll provide an update on inflation and the health of the overall economy. So let's get right into it. So the year's not over yet, but the S&P 500 and the Nasdaq have just hit all-time highs, and the Dow Jones is really trailing near its all-time high as well. And so the overall health of the US stock market is very strong. And oftentimes investors ask, well, why is that? And what could be risks that we should be paying attention to? And could the market come crashing down at some point? So I want to address all of these topics. So first of all, why is the stock market doing so well? I really boil this down to four major themes. Number one, inflation. That was the major talking point going into 2024 is what will happen with inflation. Will it come close to or approach really the Fed's 2% target? Now, as we're looking at inflation now, we're seeing that although we're not at the Fed's 2% target, we're very close to it. And so that's great news for the Federal Reserve and for the overall US economy. In addition to that, the second factor is rate cuts. And so the Federal Reserve really was more concerned about inflation and potentially having to maybe even raise interest rates again this year if inflation doesn't get under control. The concern behind this is, well, if rates stay elevated and if rates potentially go higher, this could cause more strain to the US economy, leading to potentially a recession. Now, thankfully, the fears of a recession didn't actually take place either because as we are now in December, we've seen we didn't have a recession this year. And so inflation turned out to be better than expected. We actually got interest rate cuts, which were a bit of a surprise for much of the market. Now, the third reason is the presidential election. So the outcome of the election actually provided a nice boost to the stock market as now investors are fueled with optimism that we could have potentially less regulation going into 2025, maybe even some tax cuts, which would all be economically stimulating. So the fourth reason mainly comes down to the labor market, which is an extremely important part of the overall economy. A strong labor market is generally a sign of a healthy economy, and we have had a very strong labor market. Now, there were pockets of times during the year where the Fed was concerned that the labor market was showing signs of slowing down, but we just got a jobs report today, actually, as I record this video, which showed that the November jobs report was actually hotter than expected, where the US added 227,000 jobs instead of the 200,000 that was expected. Now, unemployment did tick up to 4.2%, but here's the thing about unemployment. The historical average in the US is 5.7%, so we're still well below the historical average. So these main topics that I just mentioned are a lot of the reason why the US stock market has done so well. Now, you could also throw in there artificial intelligence and really the incredible growth that we're seeing again this year in the technology sector. But a lot of that is fueled by the underlying developments in the economy and with inflation. If any of those things were to have gone the other way, this would have potentially negatively impacted artificial intelligence in the technology sector as well. So all of these things are relatively correlated. Now, what could cause the market to come crashing down? Well, there are a few different things that could cause some serious risk to the market. Now, a crash is a bit of a loose term, right? We have corrections generally every year. There's a market correction. Now, a crash could be something more serious, 20% or more. But I'll just focus on, what could cause volatility, what could cause the market to pull back, or what are some risks that investors should pay attention to. Number one, it's, as I mentioned in the beginning of this topic, is inflation. The Fed has cut interest rates. This could cause inflation to come back, and this could be a huge risk to the overall health of the stock market. The Fed could pause rate cuts, the Fed could potentially raise interest rates again, and all of these things currently are not priced in. The market assumes everything will just go perfect, and the Fed will just keep cutting interest rates. If that story changes a little, that could be a negative impact on the overall stock market. The second thing is geopolitical tensions. Now, we've seen all throughout this year, we've had no shortage of geopolitical issues. Everything from the Ukraine Russia war to tensions in the Middle East, just recently with South Korea, with the martial law situation and all the issues that they have now in South Korea. And then, in addition to that, and the French government with their issues and having to name their fourth prime minister of the year. Thankfully, the stock market, especially in the United States, has generally shrugged all of those things off. So, but that doesn't change the fact that we could have even more geopolitical issues, potentially nuclear war in Europe, potentially even more regional tensions in the Middle East. All of those things continue to be a negative factor that could impact the stock market. Lastly, this is looking out towards 2025. A major risk for the stock market could be tariffs. Now, that's the big concern for a lot of economists right now is, okay, President Trump has announced that he will be putting tariffs on a lot of countries. It could be every country, it could be major countries, and it definitely will be China. And so, in this sense, tariffs are a bit of an unknown in the modern world. We have had times in the past in the United States where we've used a lot of trade tariffs, and it's been a great boost for the US economy. But in the modern world where everything's more globalized, trade wars could happen. You could even have kinetic warfare as a result of putting trade tariffs on other countries that may not like that. And so there are a lot of risks involved with tariffs. Could it go well? Sure, it could go really well. And I'm actually quite optimistic that the tariffs could go well. But there is a serious risk on the other side of this, and it's something economists have been worried about. Now, what we have seen with tariffs is that just the mere threat of tariffs has started at least some negotiations between countries. And I think this will develop more into 2025. But don't be surprised if we have serious volatility as a result of tariffs. And so hopefully this segment helps explain what's going on in the stock market now, what are the pros or what's been going really well, and then what are some potential risks that you should be paying attention to. And I'll end with international stocks. Now, as I just mentioned with tariffs and geopolitical developments, the US stock market is strongly outperforming the international. If you look at, for example, international stock market indexes that don't include the United States, I'm seeing those up about 9% for the year. Whereas if you look at the S&P 500, as I mentioned earlier, it's up over 28% this year. There's a clear reason for that. There's a lot more optimism in the US markets than there is now in the international markets. And so be very mindful of where you have your funds invested and talk to a portfolio manager, your financial advisor, whomever you consult with, if you'd like to have your portfolio reviewed. I think it would be very wise heading into 2025 to do this type of risk analysis to make sure you're positioned in the right places. So I'd like to conclude on a brief note about inflation. So as I talked about earlier, on December the 11th, the CPI report for the month of November will be released, and this is going to have a major impact on the Fed's decision on December the 18th of whether or not they should cut interest rates. Now, I believe the Fed will still cut rates on the 18th. Hopefully the CPI report comes as expected or maybe cooler than expected, right? So inflation is maybe lower than we expect. That'd be great news. Fed cuts in December, 25 basis points, and then we head into the new year. Now, moving into the new year, I believe the Fed will be a lot more judicial with cutting interest rates, mainly focusing on ensuring that inflation continues to head down, hopefully approaching their 2% target. Now, the Fed does have some support here because the Trump administration has talked about lowering taxes. And the administration has to pass some sort of tax legislation in 2025 because the 2017 Tax Cuts and Jobs Act is going to expire at the end of the year. And so let's say the administration is successful at lowering tax rates. This is economically stimulating. As I've talked about before, there are really two broad ways that the economy can be stimulated. One is through monetary policy. This is controlled by the Federal Reserve. This could be, for example, controlling the money supply or lowering interest rates. Now, the federal government, on the other side of the coin, they could also stimulate the economy, such as through lowering tax rates. So if the Federal Reserve looks at this and goes, hey, look, the new administration will lower tax rates, so therefore we as a Federal Reserve may not have to cut interest rates as much because there's already some stimulus happening on the federal government side of things. This is a good thing. Now, at face value, some investors might look at that as a negative, but I want you to consider the fact that Bond yields will stay a bit elevated. Money market funds will continue to pay decent interest, and private credit investments, which have done very well for the last few years in these higher rate environments, will continue to do well. And so rates coming down more than this is a good thing for stocks. It's generally a good thing for the overall economy. But if on the other side of it we get tax cuts as an economic stimulus, don't be so alarmed if the Fed decides to potentially pause their rate cutting campaign, or maybe just not cut as much. The goal here is to get inflation down to 2%, and to do so in a way where we're potentially not harming the economy. And if there are some signs of a slowdown, as we saw this year, doing things such as cutting taxes or lowering rates to stimulate where possible. And so overall, I wanted to share that outlook for next year, as I think it's a pretty likely scenario, mainly because of updates with legislation, where we're heading with inflation, and the overall commentary coming out of the Federal Reserve. Nonetheless, I'll be paying very close attention to the Fed's comments on December the 18th, where Chairman Powell will outline what he views his outlook is for 2025. And so this concludes this week's episode of Money Minutes. Thank you so much for tuning in, and I look forward to seeing you all again next week.